Welcome back to Trading Hour. Let's get a conversation going on where the markets could be headed, some of the pockets that look exciting as well right now. We have Jitendra Gohil joining us now from Kotak Alternate Asset Managers. Jitendra, thanks for being with us once again today. You know, the last time we were talking about how maybe it's time to start looking more at the large caps. There's been too much of a crazy run in the mid and small caps. But guess what? That hasn't stopped, and there are definitely pockets within that space that feel like they still have a lot of steam, right? Whether it's the PSU stocks, the PSU banks, power. Is there something that you feel, even if it's a smaller pocket within this space, that you would look at even when it's run up so much?
Yeah, hi. Thank you for inviting me on your show. I think definitely PSU pack looks a little bit more fairly valued in my view. Some of the stocks are offering good dividend yields, and too much money is chasing today Indian equities. And within that space, I think PSUs are still at a reasonable valuations. What we also notice is that in the past few years, we have underinvested in energy space, and most of these PSUs which are into energy segment, I think there the valuation is still okay in our view. And I think if we are looking at a 5 trillion, 7 trillion economy in the next few years or so, our energy intensity is going to go even higher. And because this sector was underinvested, we are seeing a lot of traction building up there. And the second point is on the mid caps versus large cap that you really mentioned. I think, yes, there are pockets where we see a lot of fraud building up, and investors are should remain cautious. But I think if you look at pockets of opportunity, some of the mid caps which are good quality mid caps, we still prefer that. For example, we like interest rate sensitive, domestic focused names such as real estate companies. But the rally has been pretty, strong over the past 3 months. We have been recommending interest rate sensitive domestic focused names and real estate. Some of the NBFCs that we really liked it, they have rallied a lot. So I feel that yes, some caution is warranted. But from sector allocation perspective, we think that large caps should be preferred at this point of time because they have substantially underperformed the mid cap space year to date. If I look at mid cap index is up 42%, while large cap is up only 14%. So I feel there could be some rotation happening towards large cap from mid caps.
Jitendra, getting back to that point about PSUs. So PSUs in the power, energy transition place like IREDA, for instance, or your PFC, RECs, NTPCs, all those are still fairly valued. And there is an opportunity, right?
Yeah, we do believe that there's some more opportunity.
Okay. Got that.
In
but what about the other PSUs in, say, in railways, defense?
So I will go stock by stock in this space because some stocks have shown remarkable performance and they are discounting next 2, 3, 4 years of growth outlook. But I think within PSU space, for example, if we have stable government in the center, we might see more traction building up overall in the PSU pack. And also, I feel that some of the disinvestment or probably privatization candidates, I think from a 12 to 18 months perspective, there could be some more headroom left for these stocks to rally, because I feel that if there is central, there's stability in the center, the disinvestment and also you would say that the privatization plays could pick up pace. So I feel that, yes, there is some more headroom for these stocks to rally further.
Okay, got that. Jitendra, you were mentioning the large caps. Take us through what looks good within the larger names, because there are a lot of pockets within that. For example, the autos, which have rallied pretty hard. So do you find that there is some more value there? Do you look at the financials? What within the large caps?
So I think, so from auto perspective, we think that there could be some profit booking in the auto space in the near term. But from a large cap space, we definitely like some of the banks. We think that banks have underperformed. The valuation is below 10-year average. So I feel that banks are clear buys from the large cap perspective. We also like some of the stocks which are into life insurance space. So we have started buying some of the life insurance companies. Financial is definitely a clear buy. In the near term, I feel that some of the cement stocks can also do well, as we see that the power demand is going up by around almost 9% financial year to date. Cement demand is also picking up pace. So power and cement in the large cap space is looking pretty attractive as of now. Consumption, we are not very bullish, but I think oil prices have fallen, and hence we see some kind of traction. And when we interacted with some of the FMCG players, they're also mentioning that rural recovery, they are showing some signs of pickup. So in the near term, I think there could be a nice trade in the FMCG counter as well. But from a medium-term perspective, we feel that the stocks are fairly valued and upside is capped. But just because the commodity prices have fallen, and we are looking at some kind of a rebound in the consumption in the near term ahead of the elections, we think that these stocks also offer a near-term buying opportunity.
What's a clear avoid for you?
Pretty tough because everything is looking so. But I think some of the railway stocks or some stocks that have done really well without any earnings improvement, right? So we think that there could be a good rotation happening within the sector itself. So I think you have to go stock by stock. We have booked profit in some of the real estate names that we recommended a few months ago, and they all are up 40% odd. So we are booking profit. So we are not sitting and looking at holding on to the winners. We think that some of the stocks which have exactly rallied significantly, one should book profit and rotate towards portfolio. For example, we are extremely positive on pharma names. So some of the pharma names that we have started buying even after this rally. We also think that we had a long underperformed view on IT. Slowly, we feel that IT sector is now coming back, and if you have some like a 6 to 9 months view, I feel that IT is looking pretty good. We have also avoided chemical stock for now, and now we have started building our exposure to chemical stocks as we believe that worst seems to be over there. So I think those sectors that we avoided for the past 3-4 quarters, now we have started buying those stocks, and stocks that have rallied. I think that's the time to book profits. I think this is what one has to do. But from a sector perspective, I think metals looking pretty weak. Chinese growth is not picking up dramatically. I think we would avoid metals as a whole.
Okay, got that. Jitendra, very interesting chat with you today, and throws up a lot of new ideas as well. Thanks for joining us and taking us through your view on the market right now. By the way, today as well, you're seeing a lot of the auto names move up in the past few minutes. You have Bajaj, Hero, which have moved up quite well. ITC is also one which is, doing well. By the way, there's an analyst meet today for ITC. So it'll be interesting to see what comes out of that. Right now, the stock is up around 1%. So that's holding up quite well. A lot of the IT names as well that we were mentioning, today they're holding up well. So, whether it's a TCS, a Wipro, even Infosys, of course, off the lows of the day. So that is what the market is doing right now. With that, we're going to get into a short break. But on